subscribe to our YouTube channel VanFin Multibaggers and press the bell icon to see the latest updates and videos. VanFin, discover opportunities, create wealth.
GDP grew at 7.5% the last 3 months of 2017, higher than what had been anticipated. Robust rise in manufacturing, construction and real estate sectors as well. Yesterday's trade data indicated some bit of improvement in merchandise exports as well. All of this, is it translating into new order inflows, or is that elusive capital account recovery still some time away? Let's put this question to somebody who supplies equipments to plants to start running. MS Unnikrishnan, the Managing Director at Thermax Johnson from Pune, to talk about this. Mr. Unnikrishnan, good morning and thank you so much for taking the time out and speaking with us at Bloomberg Quint. I remember our last conversation wherein you mentioned that some of the sectors which hitherto were nowhere in this order giving stage, starting to give orders. I think you had cited examples of fertilizer as an industry which is starting to give some orders, and a couple of other pockets. That was about 4 months ago when we had this conversation. How has been the last 3 or 4 or 5 odd months in terms of order inflows for you and as an industry captain for the sector as well?
Well, let me start on Dheeraj with Thermax and then move into the wider spectrum. We've seen some positive moves in the last 3-4 months also. Like I mentioned about in our last discussion, fertilizer orders have really fructified. We ourselves have been able to be benefiting from that from the northern side of India, where 3 of the orders which got concluded we have been able to get in our favor. I also did mention about the Bharat 6 based refinery expansion as well as modernization program. It is going on stream and most of the orders of the level 1 has completed. We had been selectively successful in that too. So refinery expansion orders have come in. We are also seeing 2 refinery capacity expansions underway. Inquiries are already in the pipeline. I would expect them to be getting concluded maybe in the next 2 to 3 quarters. The total orders which are going to be placed for the refinery equipments could be going all the way up to maybe 25,000 crores of rupees. And for companies like us, there is an opportunity near to maybe 600 to 700 crores going to come out of that also. Similarly, we are seeing a good move in the consumer facing industry, both in terms of inquiry inflow as well as order finalization. There is a continuum and there is an improvement in the inquiry inflow, which is an indicator or a precursor towards an improvement in the order intake in the next year. So that's another indication. We are seeing a stability being witnessed in Southeast Asian market. And despite the political turmoil which is witnessed in the Middle Eastern market, the inquiries for the refinery expansions are on the anvil. And there was a worry about will there be international money flowing into capacity building in the Middle East, but we don't see any negativity over there. Moving on to the international markets, beyond that, the European difficulties, despite the Brexit worries all of us had last year, is behind us. It's understood that there won't be market turmoil, though there could be some amount of readjustment going to happen. So after a period of maybe, I would say, 5 to 6 years of negative growth in the European investment sector, we would see some capacity building going to start in the current year, which should benefit us as a company with some amount of operations ensconced into the European continent. So overall, if I look at it, it looks all negatives are behind us. Unless otherwise there is a political turmoil in the world, we should be able to see some better days moving ahead. That's my conclusion.
You would believe that even if this trade war worsens, the individual pockets of investment that each of these continents or areas would do would anyways be intact, right? And that should lead to orders coming in much thicker and much faster than what we've seen in the recent past.
Yeah, there is one factor which all of us are going to be considering, that China's overcapacity, which is overshadowing any capacity building requirement in the rest of the world, is being faced by each country individually. For example, in India, there was a major worry about will we ever expand steel capacity in the country because China has got an overhang of 400 million tons per annum additional capacity in existence. But a good number of them are getting mothballed, and countries are taking punitive measures against dumping. So you can see that the minimum import price that we've installed maybe for the past 2 years has helped most of the steel companies in the country to have a positive balance sheet. And we do see two of them, especially the JSW and Tata Kalinganagar, will go ahead with the expansion of this JSW, despite being on the anvil to take over one of the NCLT steel companies. They are going ahead with the expansion, and I'm expecting even Tata Steel to come into the market with the expansion program for Kalinganagar next year. I am seeing also a spurt of inquiries coming from the sponge iron industry from the eastern sector of India. They are doing all this in anticipation of an improvement in the capacity, and I'm very happy to tell you that the government of India has constituted a committee with 3 secretaries and some of the people from the industry participating to create a roadmap for India to increase the current steel production from 130 million tons per annum to 300 million tons per annum by 2030. So even the government of India is cognizant of the fact that further growth of the country has got to happen with internal capacity creation than import dependence. So that's something in the steel industry. Similarly, in the cement industry, we are seeing the capacity utilization picking up, and in the current budget, with almost 14.5 lakh crores of rupees being committed by the government of India for rural development, a good part of which will get into internal roads. Otherwise, we are all, we get really excited about highway construction. But in the current year, the rural road construction is something which is being focused by the government, which will also be needing a lot more of cement. So we can see greenfield and brownfield expansion programs of at least some of the major good balance sheet owners of the cement industry already ongoing. So these are all positive signs, Dheeraj, visible for us. Now, concluding all of this as an uptick as well as a reversal of the negativity, I will not move into. But I would say that we are going to look forward to some better days in the coming years.
I just wanted to get a sense of the numbers. Your opening remarks spoke about you getting, I think, 6 or 7,000 crores worth of potential 6 or 7,000 crores worth of orders, or at least you being eligible for that same kind of an order as well from a particular space as well. Can we put some numbers to get a perspective? What would the order run rate have been in FY17 and the first 11 months of FY18, and what's the potential that exists over calendar year 2018 or FY19 as the case may be? If we can just do a comparison, Mr. Unnikrishnan.
Yeah, for the purpose of an indicative comparison, let me tell you that we have registered in our group near to a 4,000 crore worth of order intake in FY17, which would certainly improve by I would say 25% of an improvement in the order intake in the current year is what I'm looking forward to. And maintaining that or maybe a little better than that for the year after that is what we are targeting. Now, in capital goods industry, it is not like a consumer industry where predictabilities are almost maybe within a plus or minus 5%. In capital goods industry, if you lose a big one or maybe somebody doesn't go ahead with the finalization of a larger chunky one, you can always fall flat. But the way trend is visible, current year we are in any case heading for I mentioned you 25+% order intake. And we should be able to maintain that kind of a level for the next year, though I may target a little better.
Okay. And lastly, would this be for Thermax because you are, in a manner of speaking, a leader into multiple of these pockets, or is that opportunity size out there for other well-run companies as well? I mean, because again, the last time that we spoke, Mr. Unnikrishnan, you mentioned that orders were not so much coming in from the domestic side as much from the international arena. So are you in a sweet spot because of your presence in both of these pockets, or do you believe domestic oriented companies will also stand a chance or have a chance to get orders northwards of 20-25% year on year for the next 2 years?
No, I will not place that, because whatever is said and done, Indian economy will grow. But there are some new added ifs and buts about India related to the results of the current election. A political uncertainty that would be prevailing post FY19, post the elections. Indian growth can be muted. So one has got to be prepared for everything going forward. So I would say the companies having a global exposure will be better off than only domestic oriented companies. And even for domestic oriented companies, post the various uncertainties that prevail after the demonetization, GST implementation and allied issues, I would say economic stability is there to prevail at maybe between 6.5 to 8% growth for the next 4 to 5 years. That is sufficient for capital goods companies to see an improvement in the domestic sector also. But it may not prevail in every sector. I would say the ones which are totally dependent upon the infrastructure in toto, they may not be able to benefit out of that. But the consumer facing industries supporting capital goods industry, road building related one, they should be doing better. But I would say that it also would demand that the companies should have a decent enough balance sheet. If they are already overstretched related to working capital, and they may not be able to gather sufficient funds either from the market or from the banking system, because be careful about one factor. Entire banking system in the country is going to be getting into I would say less risk taking in terms of lending, especially for volatile businesses. So in the next 2 to 3 years, I would believe that only those who are able to have a decent enough balance sheet will be able to grow. If you have got a very weak balance sheet, there is no bank going to help you out. And it is not, I would say, negative about that, because the system is under terrific stress, because of which those who are able to manage the balance sheet only will be able to grow in the next 3-4 years' time, unless the market is willing to support them through an IPO, maybe extra funding going to come from somewhere different.
Okay, appreciate appreciate all these insights, Mr. Unnikrishnan. Thank you so much for taking the time out and